Today, I'm going to give you a complete, very easy to follow along breakdown of which mutual fund to invest in for any goal that you may have. That's right, whether it's a short-term dream, a medium-term plan, or for those big long-term goals, this video has got you covered. Hello everyone, I'm Udayan Adhye and have been licensed in Indian financial services since 2015, first in insurance and then in mutual funds. And so far, I have helped over 1,500 families make better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. Alright, so where you invest depends on when you will need that money. This is very important to know. So first, let's talk about short-term goals, which could be something like for saving for a vacation, buying a new phone, or even building an emergency fund. Basically, it could be any goal between 0 and 2 years. For these kinds of goals, safety is your top priority. And investing in the stock market, that's why, isn't ideal because the stock market is very highly volatile and risky in the short run. Do you know that in the past 44 years, the Indian stock market has dropped by at least 10% at some point in 40 out of the last 44 years. So imagine you're saving for a goal only to see the value of your money drop right when you needed it. So instead, safer options like short-term debt mutual funds or arbitrage mutual funds are better suited for your shorter-term goals. Which one to choose depends on your income tax rate, and I'll share a calculator after which you'll find out which is the right option for you. Here's a quick breakdown though of what both these types of funds are. Short-term debt funds invest in bonds that mature within 1 to 3 years. And even though this maturity exists, you can redeem your money at any point in time. There's no lock-in or restriction on that. And these funds have generated about 8.5% returns over the past 1 year. On the other hand, arbitrage funds work by profiting from price differences in two different markets. Now they are stable because fund managers enter trades only when they see a clear profit. Think of it as, if you have to buy apples and in the market close to your house, you get one apple for 100 rupees. But in a slightly far away market, you get apples, the same kind of apple for 150 rupees. So what would you do? You will buy an apple at 100 rupees from the first market and sell it in the second market for 150 rupees, pocketing your 50 rupees. So in the stock market, the price difference isn't as large, it's minuscule and fund managers tend to capitalize on it. And last year, arbitrage funds generated about 8% returns. Now, when it comes to tax, there's a difference, and that becomes important because despite this return difference, your post-tax return might be different at the end of the day. The profit from short-term debt mutual funds is taxed entirely as per your income tax slab. I'm going to again share a table very quickly, while arbitrage funds on the other hand enjoy equity kind of taxation. That means if you sell within the first year, your gains are taxed at 20%. But if you sell after 1 year, your gains up to 1.25 lakhs every year across equity instruments are tax-free, and all gains beyond 1.25 lakhs are taxed at 12.5%. Now, to help you figure out which of these two options works for you, let me share my screen and share with you this calculator. So in it, first up, you would enter the amount that you have invested, right? So let's say it's 5 lakh rupees, and let's keep your income tax rate at 30% for now. Now, I have added fixed deposits here as well because a lot of people also prefer investing for short terms in fixed deposits. So the past 1 year return, let's say in fixed deposits, let's make it 6.5. Short-term debt funds 8.5, arbitrage funds 8%. Now, if you sell within 1 year, right, what's going to happen? Look at this line. It shows you the post-tax returns. So if you're in a 30% tax bracket, your post-tax return, despite getting a higher 1 year return, is actually lower for short-term debt funds. So by the end of the day, right, by the end of that 1 year, your 5 lakhs would be worth about 5.29, whereas in arbitrage fund, they'll be worth a little more. So not a massive difference, but a little more. Now let's say this goes down to 10%, right, your income tax rate. Then in that case, the tool tells us that short-term debt funds are the way to go because again, here you get 7.65% returns, whereas here you're getting lower post-tax returns. As you can see, in every case, the FD is much further behind. Even for a 20% taxation, this is how it would look like. Again, short-term debt funds win. But then what about 1 year, right? Because remember in arbitrage funds, after 1 year, every year you get 1.25 lakhs tax-free. This is not just restricted to arbitrage funds, but all your equity funds or even direct stocks across the board. So let's say you sell your investments after 1 year. In that case, let's make the returns 8.5, even though they haven't returned as much. Both these funds, they've returned a little lower, but let's keep it at this, right? Then in that case, your income tax rate, let's say is 20%, which continues. So debt fund taxation doesn't change here. Arbitrage funds, on the other hand, if you haven't sold any equity long-term gains, and I've selected no here, then the entire profit that you're making here, right, the entire profit of 40,000 is tax-free, right, which is fantastic. So arbitrage funds in that case are a no-brainer. And let's say even in 30% taxation, obviously, the other two options fall pale. Let's see with a 10% taxation, even then arbitrage funds are winners. If you've sold gains of over 1.25 lakhs, then in that case, it makes sense potentially to invest in short-term debt funds. And this makes sense until your income tax rate is about 20%. So play around with this sheet. It's available to you to use for free. The link you'll find below the like button. So play around and figure out which one suits you better. And if you're considering investing in any one of these, the Aditya Birla Short-Term Debt Fund is a solid and very, very old bond fund, while the Kotak Equity Arbitrage Fund has a long history of good performance. And let me in fact show you how they have fared over the past many years, right? So here I am looking at data from 1st November 2005, right? I'm looking at 1 year rolling returns, and you will see here that I have compared the Nifty 50. Let's first focus on this table. I've compared the Nifty 50 and then the Aditya Birla Short-Term Debt Fund and the Kotak Equity Arbitrage Fund. First up, look at this, right? On a 1 year basis, what is the most return these have generated? You will see Nifty 50 generated about 100% returns, but we don't even want to look at that. What we want to look at is the minimum return, right? Because we're investing for shorter goals, right? 1 year, 2 years, 6 months away. So in the Nifty 50, there has been an instance here in 2008, right? Here in 2008, where the Nifty fell by 64%. At that time, look at how the two safe funds perform, right? Equity arbitrage was 7.7% up. The short-term debt fund was up 6.1%. And just look at how the Nifty has gone up and down so wildly. Whereas these two, right, are safe funds, they are relatively flat. And that's what you want in an investment where you're investing for a very short amount of time. So there you have it. I've shared with you 2 fund ideas and where you can invest for your short-term goals. Now let's talk about your goals that are 3 to 4 years away. Now for this time frame, an option to consider is something called as an equity savings fund. Now what exactly is this fund? To understand it, think of 33, 33, 33. In this fund, about 33% of the portfolio of the fund is in stocks, 33% is in arbitrage opportunities, and 33% is in bonds. So if you think about it, 66% of your money, 2/3 of your money is invested in safer assets like bonds and arbitrage plays, while the remaining 33% goes into stocks, which can potentially give you a boost of growth, while the stability will come from the safer allocations. Now let me share my screen to show you one of the oldest equity savings fund in India and how it has performed. It is called HDFC Equity Savings Fund, right? So here we go. This is how the HDFC Equity Savings Fund has performed. We look at its data on a 3-year rolling basis, 3 and 4 year rolling basis, just to see how it has fared against, again, the Nifty 50. I'm just comparing these options against Nifty 50 because I want to give you a very direct comparison between how a relatively safer investment meant for that goal would perform against a volatile or risky investment for that shorter window. In this chart, can you tell which is the Nifty 50 and which is the equity savings fund? The one that moves more is the Nifty 50, right? So here you go. We look at this table first. That will give us very specific data. So over a 3-year period, what is the minimum return that the Nifty 50 or the equity savings fund has generated? You will see that the Nifty 50 has fallen by minus 22%, right? This was the 2008 crash. Here you go. Whereas the equity savings fund at that time even actually gave a positive 2.91% return. The fall happened in the COVID crash, right? 5.34% when the Nifty 50 was down by 3 times more. And that is very evident in just how the portfolio is constructed, right? Because equity savings funds, 2/3 of the money is in a safe place, 1/3 is in risky assets like stocks. Obviously, the fall would be in a way 3x if you just compare 1:1. So there you go. Equity savings fund, you'll notice even the standard deviation is much lower, and again 1/3 lower. The entire idea, right, of this video, apart from telling you potential categories and funds where you can park your money for your various goals, the entire idea of this is also to share with you how making certain changes, making certain tweaks in the portfolio by choosing the right fund can really impact the performance while the market is doing well and while the market is also not doing well. One of the biggest advantages of an equity savings fund is its taxation. It is treated in the same way as an equity fund for tax purposes. So if you hold them for over 1 year, you get the benefit of having a lower tax rate of 12.5%, and once again, you'll enjoy that 1.25 lakhs of gains tax-free every financial year. Now, the key risk with an equity savings fund lies in that 33% stock allocation. This allocation is also the strength of this fund. While it adds potential for growth in cases of major stock market drops, that same 33% exposure can pull down your portfolio a bit. But that won't be drastic like we saw, since again only a third of your money is invested in stocks. And if you're considering equity savings funds, the ones offered by HDFC and Kotak come with long performance and histories. Now let's look at goals that are between 5 to 6 years away. Here we can consider adding a little more equity exposure or stock exposure to our portfolio, but we still want to keep some level of safety. And while 5 to 6 years may sound like a long enough time frame, being too heavy on stocks could be risky, especially if you're caught on the wrong side of a market cycle. So we want a balanced approach. Now for this time frame, a hybrid fund, especially an aggressive hybrid fund, could be a good option. This type of fund typically invests around 65 to 70% of their money in stocks, while the rest is in safer assets like bonds. And this can potentially provide stability when the markets take a hit. Let's compare the SBI Equity Hybrid Fund, one of the biggest funds in the space, to the Nifty 50 to see how it would have done, right? So here we go. You'll now see that the returns, right? The returns are pretty close to each other. You wouldn't be able to tell right away which one is the equity hybrid fund, which one is the Nifty 50. In terms of data, what does it tell us, right? The Nifty 50, the minimum returns have been minus 4.3%, whereas for an equity hybrid fund, they have been 0.7%. The median returns are very similar. In fact, on a 6-year rolling basis, right? On a 6-year rolling basis, the median returns are very similar, 14.3 and 14.8. That higher return has happened at a lower standard deviation, which is a dream, right? Which is fantastic. So there you go. An option for 6 years could be an equity hybrid fund, an aggressive hybrid fund. And while I've shared SBI here, there are other funds in the category as well, but I've chosen SBI just because it is the oldest. And here, if you notice, the first data point, right, is 2nd May 1997. So it's always interesting to see how different categories performed at different market times, right? When the market was really booming in the early 2000s after the dot-com bubble crash, then during the 2008 crash, what happened? One more interesting point, which I'll get to as I go through higher, longer term goals, is look at this, right? The 6-year performance, even of the Nifty 50 during the worst time in the Indian stock market in the past 20-25 years, the 2008 crash, you'll see a 6.09% return that the Nifty has delivered, right? So longer the time frame, if you're getting a drift of where we are going, the longer the time frame, the less risky investing in stocks becomes. So if you look closely here as well, the philosophy behind all of these choices is very, very simple. It's asset allocation. It's essentially deciding how much of each asset class, mainly stocks and bonds, you want to hold for a particular goal. For shorter term goals, we'll reduce the stock exposure to lower the risk, while for longer term goals, we increase it for the potential future growth. Now moving on to longer term goals, such as those goals that are 7 or even 8 years away, this is where an equity or stock portfolio can make more sense. Now I'm going to show you an example of the Nifty 50 on an 8-year rolling basis. And while the Nifty 50 invests in India's largest stocks, and this will be an all equity portfolio, I personally, even for my longer term goals, like to have some kind of a bond allocation, right? Whether it's 10, 15, 20%. I'll get to that, but let's first look at an all equity portfolio, right? How it would have done. So this is the Nifty 50 chart. Let's go to the table and see how it has performed. 13.5% median returns on an 8-year rolling basis. Never negative returns, right? The lowest amount of returns would have been at the time of the COVID crash, where you would have gotten 2.22% returns. But then that's something that happens rarely if you think about it, because about 12% returns, right? About 12% returns is almost 70% in this particular portfolio, which is, again, fantastic. That's why, every time you hear people talk about future returns, 12% is considered as a metric because of this data, right? Because that is what has happened in the past. Now at the same time, one more thing that I want to highlight is, look at this. We saw in the previous chart the 6-year rolling return, right? The 6-year rolling return was around 6 to 7%, if I remember that correctly. Whereas here, it is 11.64. So even during one of the craziest crashes that we have seen, the 8-year returns were 11.64% for an SIP. Whereas here, if you look at it, it was 2.2, yes. But look at how quickly, right? Look at how quickly, within 8 to 9 months, your returns were back to 11+%, which is fantastic. So this just goes on to show that, you don't want to sell at some point here. You want to ride through that big crash that comes in. So now in terms of even longer term goals, right, that are let's say 10, 11 years away, where do you invest then? Again, in a stock heavy portfolio, but then you also tweak what kind of stocks or mutual funds you hold, right? So you'll add more mid or small cap mutual funds. Right now, Nifty 50, essentially a large cap portfolio. Now with a multi-cap allocation, right? That's what I've added. What is a multi-cap allocation? If you've been a friend of this channel for a while, you know what they are, but I'll give you a quick refresher. So a multi-cap fund has to invest 25% of its money each in large cap, mid cap and small cap stocks. So at any point in time, 50%, at least 50% of the portfolio of a multi-cap fund has to be in mid and small cap stocks combined. So now let's see how they've done, right? We'll again see they follow a similar-ish pattern in terms of when they fall, when they rise. But you will notice one line, right? One line is kind of almost always higher than the Nifty 50. And that is of the multi-cap category, right? So there you go. This is the Nifty 50. Rather, this is the multi-cap index. And this is the Nifty 50. You'll see how it's almost always lower except for a few short periods. And that is reflected also in the median rolling returns, right? 10-year rolling returns. For multi-caps, it is 15.4%, whereas for the Nifty 50, it's 13.9%. Even the minimum returns are higher, right? And again, returns about 12%. If you think about it, for Nifty 50, it's about 75%. Whereas for multi-caps, right? For multi-caps, it's 67 plus 18. We are at about 85% or so. So, that gives you an idea as to the kind of growth potential that is possible in a portfolio that also has mid and small cap stocks in it. So remember, successful investing is all about matching your investments to your time frame and being patient. When you align your goals with the right asset allocation, you're not just investing money, you're building financial security for every stage of your life. And if you enjoyed watching this video, then check out my course on the complete guide to mutual fund investing. It is live now. In it, I share how you can pick mutual funds, how you can build a portfolio of mutual funds, how you can use them for various goals. I also dive deep into money mindset. I have an investor profile decoder tool which will help you understand your own money mindset better. A lot of other things are in it, so check it out. The link is in the description and the pinned comment, and I'll see you in the next one.